Dan Ives just revealed his top 5 stocks that you need to be buying for the rest of the year in 2025. In this video, we're going to be breaking down not only those individual stocks, but also, guys, the broad market, because we have so much going on in the next couple of weeks here. And again, if you can understand the big picture, it makes a lot of this short-term volatility make so much more sense. So we're going to play the Dan Ives clip. We're going to get into some of the big picture view to kind of show you guys exactly what's going on in the market here. Then we're going to start breaking down these individual stocks and whether or not you should be listening to Dan Ives at this moment right now. So guys, before we get into all of that information and analysis, if you guys do enjoy these types of videos here, make sure you go down and hit that like button. It costs you nothing to do it, but it helps me out a whole lot in spreading these videos out to as many people who actually want to learn. And again, if you never want to miss another video like this, make sure you guys are subscribed and turn on notifications so you never miss another video like this. But without further ado, let's roll the clip.
For the richest person in the world, Larry Ellison down more than 23 billion, Jeff Bezos down about 22.5 billion, Jensen Huang down more than 20 billion. What do you make of that? The fact that these tech billionaires, their companies, they powered the market over the last 2 years, but now they're taking some big losses.
It's been a dark time for Tesla shareholders, especially this year, right? I mean, because when it comes to Musk and it comes to all the opportunity and the innovation ahead, right now, it's not just brand issues, it's distractions. And I think it really starts now become almost the symbol in terms of the sell-off. Look, and I think we talk about gut check moment, Frank. I think this is going to be one of those periods for Musk, for Tesla, they really need to navigate, because this is going to be a key 3 to 6 months ahead. There's so much innovation ahead, and we continue to be so bullish. But no doubt, this has really been a really white knuckle moment for Tesla shareholders.
Dan, I got to put you on the spot. Everybody's listening to hear what you have to say. Give us your top picks in tech at this point, not what's going to work 10 years from now. I mean, for people that are buying, looking for opportunities over the next year or so, I want to point something else out. This is from Bespoke. So obviously yesterday, one of the worst days for the stock market in years. The NASDAQ, it's fallen a similar amount over the last 13 trading days than it did in the first 13 trading days of COVID, just to kind of put that in perspective. What are your top picks? What would you buy on the dip right now?
I think there's 5 names here that I buy in terms of the names that I view as just table pounders relative to where I see it 6, 12 months now. It's NVIDIA, it's Apple, it's Microsoft, it's Tesla, it's Palantir. To me, those are the 5 names, the way that they've sold off, that I continue to view as sort of the names that I would own over these next 3, 6 months. Right here, right now.
Okay.
So as you guys heard in that clip there, Dan Ives is incredibly bullish right now. He's saying these are names that he would go out and buy at this very moment. NVIDIA, Apple, Tesla, Microsoft, and Palantir here. Again, all names that had really strong periods of growth in 2024 and have witnessed some pretty significant pullbacks coming into the first quarter of 2025 here. Now, what I really want to start talking about in this video before we get into those individual names and whether or not I think, again, it's a good idea to start dipping your toe back into these names, or maybe initiating some positions in these if you guys do not have them already. The big picture, guys, is incredibly important of the macro situation, the overall economy, and the overall market. If you're able to understand what is actually happening in the overall landscape, it not only makes the short-term volatility a lot more manageable, but it enables you to really, really outperform everybody else because you have better information and a better understanding of that information than everybody else. And that's kind of what this channel is for here. So the first thing that I want to start talking about to kind of set this landscape here is some comments from the FOMC meeting minutes from the December meeting. Now, again, if you guys have been paying attention, the December FOMC meeting is really when we started to see all of this volatility in markets with that hawkish cut. With regard to the outlook for inflation, participants expected that inflation would continue to move towards 2%, although they noted that recent higher than expected readings on inflation and the effects of potential changes in trade and immigration policy, remember tariffs, and then closing off of the border, suggested that the process could take longer than previously anticipated. Several observed that the disinflationary process, so inflation moving down, may have stalled temporarily or noted the risk that it could. A couple of participants judged that positive sentiment in financial markets and momentum in economic activity could continue to put upward pressure on inflation. So what they're saying here is that the overall sentiment in the market, in the overall economy, especially from consumers, could continue to put this upward pressure on prices and in the overall economy. We're going to take a look at and see if that's actually true right now in a second. But they were also citing that they believed that a lot of the effects of these tariffs were going to be, or there was a risk that they could be pretty inflationary. That is effectively what the textbook told them. Now, when we move over here, in the FOMC meeting this week, we received some very interesting comments from Jerome Powell. Not only that they were okay with kind of being behind the curve and letting themselves get behind the curve with this potential growth slowdown, but this one right here really caught my attention, and I think this gives a really good opportunity for us, especially as we head into this April 2nd deadline. So this is a statement from Jerome Powell. Okay, so how much of it is tariffs? So let me say it is going to be very difficult to have a precise assessment of how much inflation is coming from tariffs and from other, and that's already the case. You may have seen that goods inflation moved up pretty significantly in the first 2 months of the year. Trying to track that back to actual tariff increases, given what was tariff and what was not, is very, very challenging. So then he says some of it, the answer is clearly some of it. A good part of it is coming from tariffs. Well, the problem with this statement, guys, is that the only tariff that went into effect here was not even in January. It was in February, and it was only the China 10% tariffs because, as we all know, the 25% Mexico and Canada tariffs got delayed until March. So, and again, Donald Trump got inaugurated at the end of January, so there really were no effects of these tariffs. So this is a very interesting comment, in my opinion, from the Fed. It really does seem like they're leaning into this narrative here that tariffs are going to be very inflationary. But then they kind of walk this back here in that same meeting and say, as I've mentioned, it can be the case that it's appropriate sometimes to look through inflation if it's going to go away quickly without action by us, if it's transitory. And that can be the case in the case of tariff inflation. So they're kind of saying we do think that there's risks to inflation to the upside here, but even if we do start to see some of these price increases due to the effects of these tariffs, they believe it's going to be transitory here. So they don't actually really think that it's going to be a big risk here. So this is very interesting. So even if we are to see, again, just like I said, inflation maybe pops up a little bit but moves down, we are still in a completely different environment than these last couple of administrations have really put us in. And it really has to do with the lower amounts of government spending, the decreased amount of government hiring, and the increased amount of government firing. If you guys know the statistics, about a third of GDP every single year comes as a direct result from government spending. And then also, if you are going to be firing a lot of these government employees, that can create a negative drag on non-farm payrolls and an upward pressure on the unemployment rate. So you have lower growth, upward pressure on unemployment rate, and potentially inflation might pop up a little bit, maybe, or it's probably going to continue this downward trend that we have recently started over the last month or so here when we saw that initial spike to the upside. And again, that is a seasonal thing that does tend to happen, that inflation does move back up in the beginning of the year here. Now, this doesn't even account for the fact that Trump has said that there's flexibility on these reciprocal tariffs here. So there may not be a need on April 2nd to slap even more or increase the amounts of tariffs on these other countries. And I think that creates a really interesting opportunity to fade a lot of what the Fed is saying here. And you also have Fundstrat analyst Tom Lee taking a relatively similar view as well in many of his CNBC interviews and some of the other videos and content that he has put out over the last couple of weeks here too, that he does think that this could be a tradable bottom. He's referenced periods in the past like the Cuban Missile Crisis. But again, let's actually hear it from Tom Lee himself, and then let's move on with this video here, talk a little bit more about macro, and then get into these individual stocks.
What do you make of this report? I mean, part of the uncertainty of all of this has been the, iron fist, maybe olive branch. Back to the iron fist, maybe an olive branch. What do you make of it?
Well, I think markets should interpret it positively, because I think when we talk to our clients, many are viewing tariffs as punitive, potentially protectionist, and driving several economies into recession. This sounds like that we could actually have a positive case scenario with these tariffs, one that's either mutually agreed upon or if it's reciprocal, but maybe a good deal for businesses. And I think it would stage set the stage for a much bigger recovery rally than we expect.
Afterwards, right?
Yes,
I mean,
after.
So again, Tom Lee is saying this, Dan Ives is incredibly bullish, and I do think that, again, the market is really putting a little bit too much weight on this upward inflationary risk. And if you think back to that brief comment that we talked about with the Fed talking about overall consumer sentiment towards the economy here, well, when we move over and take a look at this chart, the U Michigan Consumer Sentiment Index, this has been on a massive downtrend ever since December. And this could be, again, a lot of these times when you do see consumer sentiment moving down, this can be a self-fulfilling prophecy where if consumers have a lot less confidence in their current financial situation, well, they're probably not going to go out and make those discretionary purchases that they would have made if they had a lot more confidence in not only their own personal financial situation, but also the economy moving in a direction that is going to benefit them. So that's kind of the landscape here. And again, when we take a look at the broad market here, this is the chart of the S&P 500 futures. This to me right now, and I've been talking about this a lot in not only my private community, but in some of the other groups that I participate in with, again, some very successful financial professionals. The bulls are in control here right now in the market. We have made a short-term bottom. We have shifted trend. We have made a higher low, and we are starting to hold this very interesting prior all-time high zone here. But again, it is going to be interesting to see how we trade next week. But right now, I would say this is favoring the bulls. Now, again, just thinking about the broad market here, what I'm not saying is going to happen is that we just rip vertically all the way back to these all-time highs here. But what could happen instead is we start running back up to this zone, kind of right in here. On ES, that's about 5860 to 5900 there. That would be a decent area where I think this market could trade up to and then start to kind of figure out where it wants to go next, depending on all of the incoming economic data that we are going to be receiving next. Now, let's talk about these 5 stocks here. I know this is going to be a behemoth of a video. Hopefully you guys are still paying attention because there is going to be a lot more value coming forward here. So, NVIDIA. When we think about NVIDIA, guys, the one thing that you always have to keep in mind, or really two things, is CapEx and ROI. Throughout the last earnings season, we did see a lot of the other big Mag 7 names saying that they were going to continue their capital expenditures in the AI space, trying to get ahead in this AI revolution, and that is going to be a positive driving force for NVIDIA's earnings moving forward, especially with the release of all of these new products that they have, because when they release a new product, it does make those prior products a lot of the times obsolete. So they are probably going to continue to see a lot of this inflow of capital. The problem then becomes, or a risk that we have in the future with NVIDIA right now, is if all of these other companies, like Facebook, Apple, Tesla, Microsoft, all of these other companies are not able to get a significant return on investment from the capital that they are deploying into these NVIDIA products, and then that's going to lead to decreased CapEx, some earnings write-downs, and NVIDIA could be a negative beneficiary of that type of scenario. But in my opinion, we are not there yet. We're probably at least 4 or 5 quarters away from that really starting to show its face. And again, just looking technically at this chart on NVIDIA right now, what I would say is that this is not necessarily something that me personally, I would go out and buy right now. Couple of the reasons for that. I mean, again, I own AMD at $11.39, so I kind of already have a lot of exposure to the semiconductor space. I don't really need any more. Again, I was selling and taking profits on that position, but it was absolutely skyrocketing last year, which was fun. But again, NVIDIA, this red line that you guys see right here is the 200 exponential moving average. Until we can get a nice break above this area here, retest it, and know that the buyers are going to come and support this level here, I would be a little bit cautious with starting to kind of filter back into a company like NVIDIA here. Now, let's talk a little bit about Apple before we get into Tesla, Microsoft, and Palantir. Again, kind of the same story with Apple here. Again, I'd like to see a little bit more innovation in Apple's products, releasing new products, and not really just coming out and saying, okay, here's a new phone. There's a couple of things that are different. and that's really it. But again, looking at this Apple chart right here, you are just kind of coming up, kissing this daily 10 exponential moving average. You are setting up a little bit of a bear flag on the daily here. So this is really not one that I would personally want to go out and start putting up money into just yet. Again, very similar with NVIDIA. I'd like to see us get back above that daily 200 exponential moving average, right around that 224, 225 area, retest it, know that the buyers are going to come up there and support us, and then you can get that move potentially up to these recent highs. Now, Tesla is an interesting story here because it's in a little bit of a different scenario because it's drawn down so much more significantly than a lot of these other names, mainly due to the brand concerns and the overall situation right now with Elon Musk, the sentiment towards Elon Musk, and the fact that he is spending a lot of his time at Doge and working in the government instead of focusing in on Tesla here. And Q1 is not looking to be the best quarter for Tesla, but I think as you guys have kind of realized a lot in the past that Elon likes to come out with a lot of I don't want to say hype, and I don't want to say he's pumping, but he does provide a lot of positive outlooks on Tesla and the company when he does come out and speak about the company during the earnings reports. And when you look at this chart here, this is starting to set up what I like to call a base and break look. For those of you guys that don't know, my 3-pillared setup for what I like to see when I start to initiate or add to some of these mid to long-term position trades. I really like to see basis here, and we are starting to see that with Tesla. If you can crack above 251.70 here or right around 252, if you are a Tesla bull and you really want to start picking up some more shares, I would say that is not the worst time to start to pick up some shares of Tesla here. You are back down into these ranges where the buyers stepped up very significantly at those points last year. So Tesla right now, I would say, is not at the worst spot if you want to continue your dollar cost averaging process here. Microsoft, little bit of a similar story here. You are peaking back towards and above that daily 10 exponential moving average. You do have a little bit of a base and break setup here. But again, getting above this really 293 area would be where I would say is where you would want to start those purchases of Microsoft if that's something that you were to do. But again, you kind of are having this little bear flag here. I'd want to see a lot of confirmation out of this market in general. That's why we talked a lot about macro and kind of the broad market and looking at the indexes before we started talking about these individual stocks here. Because again, if the market starts to rip back to the upside, I would not be surprised if Microsoft ripped right back to 400 and over the next couple of weeks here made an attempt at this 200 exponential moving average. But again, if you do decide to purchase Microsoft down here, be very aware that you could come up to this 200 EMA and start to reject, very similar to what it did these 2 times where it broke down below, retested it, and continued moving to the downside. Now, let's talk about the most interesting one here, because the last one on the list, I actually think, and again, we've talked about this stock a decent amount on this channel over the past couple of weeks here, Palantir. I actually think this one is set up for a pretty nice move to the upside here. I'll tell you guys right now, I do have some kind of like shorter dated calls on this right now with this break that we talked about of right around 89 here. But looking at Palantir and just kind of reiterating some of the points that I've made in prior videos, Alex Karp has kind of hinted to us that even though the Pentagon and the DoD is looking to cut spending, what Alex Karp has said is effectively, if you are looking to really transform an organization, what do? Well, you buy the best technology and you implement it in order to make that institution a lot more efficient and better over the long run. So what he's effectively saying is, again, even if these other companies are going to get their government contracts cut, Palantir is probably not going to be on the chopping block there, and it actually creates an opportunity for Palantir to come in and actually scoop up some of those contracts there, because again, the government is going to need some of these services and software to perform a lot of its tasks, and Palantir is in the best position possible for that. So again, Palantir could end up moving through this 93 area here. moving up to that 96 area. But what I will say right now is this chart and this situation with Palantir, for me, is just a trade. This valuation that we see in Palantir right now, when you look at price to sales, is still incredibly expensive. I owned this stock at $15, rode it all the way up to 71, sold it at 71, and I'll tell you guys right now, even though it ran up to 125 there, I would sell it at 71 10 times out of 10. If we do end up seeing some significant drawdowns in the market and in Palantir, and that valuation can kind of get a little bit better for what I want to see, I will definitely consider putting some more money back into this company, because I do really think the future prospects of this organization are very promising. It's just a little bit too expensive for me in the present to go out, in terms of a valuation perspective, to go out and start purchasing more shares for a long-term position on this one. So, guys, that was a long video here. Hopefully you guys made it to the end. If you guys did enjoy the information and analysis I provided for you guys in this one, make sure you go down and hit that like button. It costs you nothing to do it, but it helps me out a whole lot in getting this information out to as many people who actually want to learn. And again, if you guys do want to see more videos like this, make sure you guys are subscribed and turn on notifications so you never miss another one of these videos as soon as they are posted live. But again, guys, have a great rest of your weekend. I'll see you in the next one. Peace.